We're sort of looking for direction. Everyone's trying to game what's going to happen at the G20 meeting. Just take a look at the sectors here. Banks having a great day. That capital situation really improving. Dividends, buybacks better. So there's your banks. They've been outperforming. Semis, there's your China play. There's metals and mining. This is also the classic China play on the upside. Energy also doing fairly well this week. So it's a very difficult situation to figure out here. In theory, the risk is to the downside because the markets are at new highs, but everyone is positioned for a global slowdown. So they're light on equities and really, really long on the bond deals here. So Mr. Subramanian over at Bank of America, I think he had it right this morning. He had a no doubt. Trade truce, nothing going to happen. Limited upside. That's what the market's anticipating, a truce. No new tariffs. If we get a full trade deal, maybe we go up to 3,100, 5, 6, 7, 8%. If there are more tariffs on over the weekend, we go down 5 to 10%. I think this is a very fair assessment. This is sort of where the market is right now. The funny thing is the global trade talks are very closely aligned with the perception of slowing global momentum and slowing global economy. If you look at the fund flows, the first half of the year is over. Look at these ETF fund flows. Money is flowing into the bond funds. Everyone's predicting slower economic growth. So we're talking about taxable bonds had 11% inflows. The money going into taxable bonds increased 11% in the first half of the year. That's how to read this. Municipal bonds, who buys them? They're up 9%. Equities, very little inflows. And most of this is these low momentum ETFs. Nobody ever bought these things before. Those are defensive plays. So the market is positioned defensively, and that's why the pain trade is actually if the market goes up, because everyone's positioned so defensively right now here. Maybe we'll get some competition out there. Did you see these bank reports? You heard what Wilf was talking about. I hope you were listening to Wilf, because I do. J.P. Morgan Chase has now got a 3.3% dividend yield. Bank of America, 2.6, 2.5. There's a lot of the regional banks that are 3 and 3.5%. This is starting to look interesting. The S&P is only 2%. For crying out loud. And you start going in the 3.5% range, now you're looking at utility type of returns. This is starting to get interesting, and this may make banks a little bit more attractive here. Take a look, though, as what we've seen in the first half of the year in terms of IPOs. The consensus totally wrong. Remember at the beginning of the year, nobody wants 200 IPOs. There's too many. They're going to price them too high. The market's going to fall apart. The only thing anybody wants is Uber and Lyft, right? How'd that work out? Everyone was wrong. 62 IPOs raised $25 billion. The second quarter was the most active quarter in 4 years. We had the most capital raised in 5 years. That includes the Uber IPO. Look at this return, 30%. That's twice as much as is typical. Everyone was wrong. People loved IPOs, and it was Uber and Lyft that was to the downside for the quarter. We got the big names that are out there waiting in the second half of the year. We've got some names that are like WeWork, Peloton, Postmates, Airbnb, Poshmark, Casper. They're all sitting out there. Finally, just a quick note today. The Russell is going to reconstitute at the close. It happens once a year. And I think what's going to happen that's interesting is all of these IPOs that we saw, they're going to be going into the Russell 1000. Just keep an eye on this. You'll see some volume at the end of the day on those particular stocks. Been a great first half of the year. Look forward to the second half.